Okay, we are live. I'm going to give everybody just a few seconds here to join us, as I know it always takes a little bit to get logged in. So go give everyone a few seconds here, but very excited for our conversation today. I'll briefly introduce the topics and what we'll be discussing here in just a second. And one thing that I do want to say from the very, very beginning, and I'll reiterate this as well, is we are going to have time for questions at the end of our conversation today. So as we are going along, we encourage everybody to please leave questions on the comment section here on the right-hand side of your screen. So you should see a little button that says comments. Please feel free to leave comments in the form of questions. We're going to be monitoring those as we go along. And then by the end of the conversation, we will direct these questions to our speakers. So without further ado, I want to welcome everybody to our conversation for today. I'm really excited about this one. First off, my name is Josh Amster. I'm the Chief Revenue Officer here at StartEngine. I'll be moderating today's discussion, which is going to be focused around the future of capital markets and regulation. We've got some very, very special speakers for today, and so want to get into that as quickly as we can. So many of you might recognize our founder and CEO, Howard Marks. Howard, welcome. Thank you for joining us here today.
Thank you, Josh. Really excited about this webinar.
Fantastic. And then we have an extremely special guest with us here today. And Dr. Michael Piwowar is here. Dr. Michael Piwowar was the former commissioner and acting chairman of the SEC, served as a senior economic advisor for the Bush and Obama administrations, and is a true expert on the global markets. And so, Mike, welcome. Thank you for joining us. And if you actually don't mind giving a little bit more background on yourself for the audience, I think that would be really helpful for everybody to better understand who you are and your background.
Sure. Thanks, Josh. And thanks, Howard, for inviting me to speak today. So the first thing I need to do is put on my old regulator hat and give a disclaimer. Anything I talk about today, I'm not providing any investment advice, solely for informational and educational purposes. And on the educational part, I was also a former finance professor in a previous life, former academic, where I taught investment courses to undergraduates and to graduate students. And then, as Josh mentioned, I was in the government. Most relevant to this conversation, I was a commissioner at the Securities and Exchange Commission and acting chairman there. And now I work at the Milken Institute, which is a nonpartisan think tank, where I lead the finance pillar, which is all about how do we use finance as a source for economic mobility. The through line with my entire career was how to find ways to democratize capital for the folks that the entrepreneurs that need that capital. And the flip side of that is diversifying and democratizing investment opportunities for the investors in those companies. And that's exactly what StartEngine does. And so I'm really happy to be here and join Howard for this conversation.
Great. Well, we are very excited that you are here as well. So today's topics, we're going to cover a few different things. The first thing really talking about the accessibility of investing into the private markets and how that's become a new landscape for many sophisticated individuals and being able to diversify their portfolio. So we'll talk a little bit about that access. We'll go into the IPO uncertainty that exists in the markets today. We're seeing a lot of companies that are very, very large, late stage private companies that are reluctant to go private. What's causing that? Is that going to change? And so we'll talk a little bit about that. We're going to talk about the secondary markets, platforms like StartEngine, how we and others are unlocking investment opportunities into private equity, and go into some more details there. And then also the concept of the 50-30-20 portfolio split, with specifically 20% of that split being dedicated to private equity. So those are some of the topics that we're going to cover in today's discussion. Again, last thing I want to say is please, we encourage everybody to leave questions and comments. We will have time at the end to address those to our speakers today. So without further ado, Howard, I'll let you take it away.
Thank you, Josh. And thank you, Mike, for joining us. So this chart, I wanted to start with a chart because I think it says a lot and it's easy to look at. If you see this chart here, you have the pricing based on Caplight, which is a firm that collects information from pricing in the private markets and also looks at the public markets. And if you see here, you have the NASDAQ 100, which are the top, I would call, tech firms, and that includes the largest AI, cloud hosting firms, computing firms, tech, and they grew 20%, over a certain period of time. But the private markets, which are the companies like, OpenAI, Anthropic, SpaceX, these kinds of companies, 148%. And these are averages, by the way. So if you see this, the first question is, how is it possible that the private markets have grown 7x over what the public markets are? Because you would expect the public markets would have the best companies in there. And this is the topic of our conversation today, is the why and what's the opportunity for all of you. So Mike, I think you've thought about this a lot. Maybe you can give us some clarity of what's going on.
Yeah, so as you pointed out, right, so the one thing the private markets do is give exposures to new sectors, right? And you mentioned AI is sort of the obvious one. Also other tech companies, young tech growth, high growth tech companies. So for example, financial technology, fintech companies, or companies like SpaceX and some of the other ones. And so when companies are young, they start out as private companies. And then the traditional path forward was that at some point they go public early in their life cycle. But what we've seen is a trend over the last, say, 20 years is that companies are staying private longer. And we can talk about some of the reasons for that. I know we want to get into that later in the conversation. But to answer your question, is you're getting exposures to sectors that you normally wouldn't get access to. These companies tend to be younger, more in their growth stage. Now, young companies and growth companies, on average, tend to be riskier and in isolation. And this is the key point here, is that you are going to get some companies that are maybe riskier than in the average public company who's more of a mature company. But the key point here that I used to teach in the finance courses is that it's not the risk in isolation that matters only. It's really are you getting exposure to assets that are not perfectly correlated with what's already in your portfolio? So if you have only public companies in your portfolio, now you're getting access to companies in the private markets that aren't perfectly correlated. They don't have to be negatively correlated. They don't have to be uncorrelated. Just as long as they're not perfectly correlated, you can add riskier companies in isolation to your portfolio. And there's something called modern portfolio theory. It involves a lot of math, but basically it shows that you can add those companies to your portfolio and your portfolio risk doesn't have to go up. It may actually even go down. And then you get access to higher expected return companies.
Thank you, Mike. Let's go to the next slide. So here you look at the public markets, and we just discussed it, but this gives you another sense that if we just focus on AI only, so Mike mentioned AI, hey, are you missing out on the AI opportunity? And it's pretty obvious here. This slide shows there's very little AI in the existing public markets, and yet in the private markets, it's a lot. And it makes sense because AI is not a brand new technology. What's new is that in the last 5 years, AI has exploded. And I don't think anybody could have predicted it, because if they did, obviously they would have done extremely well investing in it. But there was a trend already 5 years ago to invest in AI. However, it was not apparent to the general public. And when ChatGPT came out, I think the general public got inspired by this real incredible technology and said, hey, how do I get in on it? And they couldn't, because OpenAI is private. And so is Anthropic, and so is Perplexity, and so is XAI, and all these other companies. So if you see here the difference of return, it's significant in a year. And that, again, has to do with the fact that private companies tend to have the innovation, and then the public companies are giving access to already completed innovation, or on its way to even get bigger, but at least they've passed the mark of startup to, as Mike was saying, more mature. In your experience, Mike, when you see for the last 20 years, is this an unusual phenomena?
No, it's actually part of a general trend. So one of the other government jobs I had was I was on the Senate Banking Committee, and in 2012, President Obama joined with House Republicans to pass something called the Jumpstart Our Business Startups Act, called the Jobs Act. And what was that about? That was about trying to improve the public capital markets, because what we saw was that companies, the general trend was that they were waiting longer to go public. And one of the reasons is because the costs of going public were so high. And I'll just give one anecdotal example. About 10 years ago, I was in Silicon Valley talking to folks about why they weren't going public. And I was with a unicorn company, a tech company, and I was sitting with their entire legal staff, which was 2 attorneys for the entire company. And they said, if we were to go public, we'd have to hire an army of folks, get more outside law firms, and the legal and compliance costs would go up. And that's exactly what the Jobs Act tried to do. It created something called the IPO on-ramp, which has scaled regulation and scaled compliance for companies to go public. So instead of when you went public, it used to be all of a sudden your compliance costs it was like a cliff effect. Now you can sort of scale that up. So that's as far as regulation can go on the cost side. And actually the Securities and Exchange Commission today, the chairman of the SEC, Paul Atkins, from the beginning has said he wants to make IPOs great again. And the SEC is going to be doing some things on that to try to do that. But at the same time, what we've been seeing in the private markets is that the relative benefit of going public is actually going down. Said another way, the private markets are starting to replicate a lot of the benefits of what the public markets did, right? So as I mentioned, why would you go public? Well, one was you needed a liquidity event. You had some of the founders and initial investors, initial employees needed a liquidity event. So you had to go public to get that. And now with private markets, the volume of secondary transactions has been going up. And so you can get that. The other was to get a price discovery. And why did you need a price? Well, one, so you could get the liquidity event, but then also as a strategy, the smaller companies, as I mentioned, potentially either getting acquired or being an acquirer, you wanted to establish what your price was based on an arm's length secondary market transaction. And the private markets have really taken it off. So both the costs of going public, even though that's come down a lot, the relative benefits have gone public has also gone down. And so private markets are stepping in and filling that need for the things that it used to be only public markets could serve. Now, you mentioned AI in particular as a particular industry. If you think about them, these are, as you mentioned, long-term bets, right? I mean, as Mark Andreessen said, 10-year bets. He doesn't care what happens to interest rates. He doesn't care about quarterly earnings. In fact, they can be a distraction. These are long-term bets based on, Howard, you point out innovation, right? It's not next quarter's sales or the annual sales or those sorts of things. So these are companies that are going on a long-term innovation trend. And so they in particular, and all tech companies are ripe for staying private longer.
Thank you, Mike. And what's interesting with this chart is that I think the people who are here listening to us today are looking at this chart and saying, well, I have a portfolio and I did well if I invested in the QQQ, which is the top 100 NASDAQ tech companies. But hold on a second. I didn't get 200%. And people who invested in private markets, such as StartEngine Private, got a tremendous boost on some of their investments. Obviously, they would have to diversify to get the boost. You know, if you made one bad bet, that doesn't work. One investment and that one didn't do well, where the one next to it generated a multiple. So what you were talking about, Mike, is the portfolio diversification is so critical to any of these conversations, because no one can be a perfect stock picker. Let's go and look at the next slide. And now this illustrates a little bit what we were talking about. And in the private market, you have companies who could easily be public, right, Mike? I mean, Stripe, SpaceX, why aren't they public?
Yeah, again, they're looking at what are the relative costs and benefits from doing this, right? You've got private capital. They have access to a lot of investors. And you know, the other thing is, used to be you could get access in the private markets, but the cost of capital in the private markets was very high for those that needed the capital. And the reason for that was there wasn't a lot of competition among the investors, right? So the venture cap industry has really taken off in the last 20 years, right? You used to have a few number of firms. Now you have a lot that are invested, that are going into that space. And so, and you have a lot of institutional investors that are now investing more in the private markets. And so there's a lot of capital there. So the cost of capital is much lower. So that's why they can stay there. They can, you know, if they want a liquidity event, there's plenty of opportunities for secondary market transactions for them. And then it's kind of, you know, as I talk to the lawyers from some of these private companies, they're like, why bother? Or the CEOs, they say, look, I want to manage my company. I don't want to be managing to the next quarterly earnings report and having to explain exactly what's going on in the public markets. Right now, the SEC has been looking at, well, why don't we could possibly move to semi-annual reporting, and that would potentially lower the cost. But that's not very big. I mean, these are, as Mark Andreessen says, these are 10-year bets, right? And you got to be willing, if you want to invest in these companies, you really got to be willing to have the long-term view. And these companies, it's going to take them a while for those bets to pay off. And so why bother? They just don't need to right now.
Yeah, I agree with you. And if you look at this chart, most of those companies were offered on StartEngine in the past 2 years, StartEngine Private, which are giving them access to these companies. You mentioned something was interesting. You called it the secondary. Let me explain what we've seen on secondary. So what happens, for example, is SpaceX is going to say once a year, we're going to allow our employees and some of our very early investors to cash out. Here's how. They'll say, okay, we'll have a $5 billion offer. And they go to the market, see who wants to invest, so including people who we work with. That $5 billion licomes from the market into the hands of the company, and they buy the shares from all of these employees and early investors. And that's a liquidity event. So they could have said, look, take 20% of your shares. Now you have cash. You can use that for a down payment on a house or some of your financial needs, or diversify. You know, maybe you have all your net worth in your SpaceX shares. So we're seeing this on an ongoing basis, accelerating. These events used to not happen because the company would say, no, we don't want to do this kind of secondary event because we want to go public and we feel it's better to wait, and everybody waits, but then you go public. But what happens if you don't go public? What happens if you take longer to go public? That's where the trend has been much bigger and the number of events accelerating, where you will see even smaller companies do the same thing, a secondary offering, and the demand is strong. The demand is there. And who's part of the demand? Us, StartEngine. We are in the markets every day talking to brokers, funds, VCs, companies, every day trying to figure out, okay, Where's the next event? Is this something we should be looking at? And that is really a brand new, I would say, opportunity for the last few years. Access to private equity like this, private equity mean private companies, access to private companies was extremely hard in the past. I would call it, you got to be part of a club, you got to know someone, you got to be in the know, and they have to want to accept you. The VCs, that's their profession, that's easy. And can you imagine at that time getting inside early stage, mid stage was just too hard. But today it has been, I would call it, democratized, a little bit more access, and I think it's going to keep growing. Frankly, that's my view. Let's look at the next slide.
Yeah. Hey, Howard, can I add something too? You just reminded me of something. The other thing is when you have, the early investors, the VCs are still invested in the company, right? So contrast that with companies that have been public for a while, right? The VCs eventually cash out and you see who's on the board. And you get people who are well connected on the boards of public companies, or you get experts in accounting, for Sarbanes-Oxley and all this other stuff. Who's on the board of these early private companies? It's the VCs themselves, and they have a vested interest as the largest shareholders to provide their expertise. And particularly when you're in tech companies, these VCs play a very important role. It's like having a free consulting firm or a strategic firm for them because they're seeing a lot of different companies out there. They know the competitive landscape that's there, and they're providing a lot of expertise to the CEOs and founders who are very, narrowly focused on their particular business. And so they can be very helpful to them.
Yeah, I agree, Mike. The concentration of expertise and talent is just mind-blowing. So if you look at this slide, now we're talking about how big is this private market. The private market for private companies, and again, as a reminder, all the AI companies, space companies, defense companies, all these companies, when you add up the secondaries, which is when they say, hey, we want to cash out some of our employees, some of our early investors, because we think we're going to stay private a little longer, has created what we call a market opportunity and liquidity. What does that really mean? That means that all those shares they're going to be selling are going to go out into the market, and those shares are going to continue to trade. That kind of sounds like the public market, NASDAQ, New York Stock Exchange, but unlike public companies, you don't have access to their financials. They're not available. You just have access to public information such as news reports and anything the company discloses. And look at this, the growth on an annual basis for the over 10 years ago is 13% growth. And if you look at last year, it's estimated of 122 billion. That's over the previous year of 114. And before it was 85, 87. I mean, it's incredible going from 25 billion to 122 billion. And it's going to, in my opinion, keep growing because the same phenomena is not going to change, which is companies are going to stay private longer and investors want access to it. And that the only way it happens is through these secondaries and what we're talking today, StartEngine Private. What do you think, Mike, in terms of the future of this?
Yeah, I see this trend continuing to go up for a long time for sort of two reasons. One, the definition of accredited investor is going to be opened up by the SEC at some point. It's been a long-standing issue with a lot of members of Congress, right? So the accredited investor definition is supposed to be based on sophistication, right? Are you sophisticated enough to invest in these companies that, as you point out, don't have public company filings with the Securities and Exchange Commission and stuff? But the definition defines sophistication as to your net worth or your net income. And so if you're rich, you're an accredited investor. There's a lot of sophisticated folks out there that could be added to the thing. And so the SEC is actively looking at, Congress is looking into this too. They could require the SEC to do it, but I think the current commission is going to increase it. So, there have been suggestions of, if you allow people to take a test could they be able to test into this and prove themselves sophisticated? So, and there's a number of different ways, but the point here is that the investor base of people who are able to invest in private companies is going to increase very soon, and it's going to continue increasing. And so that pushes up demand for these things. The other thing you mentioned is that, it's with the secondary market transaction, it's kind of like what's already happening in the public markets. And I can tell you there is a lot of competition by intermediaries to help make those, the private market secondary transactions a lot more like public secondary market transactions. So you've got companies that are out there helping to manage cap tables so that you don't go over the total shareholder threshold number, and then you have to, affect to be a public company. So you got companies doing that. You've got market makers and other folks that are getting into that are market makers in the public capital markets that are coming into the private markets. You've got exchanges that are looking in to helping to develop this market. So they can start out as private companies on a lower tier of their exchange, and then graduate eventually into the public companies, and that's how they can get more public company listings. And the exchanges, if you think about their business model, if there's fewer public companies for them to list, they're going to want to start to go down and diversify into the private companies. So for those reasons, I just see these trends continuing.
Thank you, Mike. Let's go to the next slide. So finally, this comes down to, I would say, the fundamental concept. It's fundamental. So we talked about how if you want to get access to a sector that is not on the public market, like AI is a great example. And there will be many more sectors. This AI is not the only one. You have to you need the ability to invest in private markets. And that means, for example, what StartEngine is doing with StartEngine Private is giving you access to these things. And the reason is, well, it's simple. That's where a lot of new growth opportunities are. And if you don't have them in your portfolio, you're not fully diversified. So Larry Fink, who's the CEO of BlackRock, introduced a concept that is another very important concept, is that in the past, the recommendation is you have to have 60% in equities, stocks, funds, ETFs, mutual funds, and 40% in fixed income, treasuries, CDs, money markets, all these things. And he said, no, we're moving towards a 50, 30, 20, 20 being what we call private equity, which are comprised of private companies, private credit, which are loans to small companies, gold, why not? Gold is very popular right now. Having just the 60-40 is just not enough to have a well-diversified, uncorrelated portfolio. That 20 is what we're talking about today, which is private companies. Part of it is private companies. We divided it up into, we said, okay, well, 20 is great, but how much should be in pre-IPO private companies? So we're thinking maybe half. The other half would be private credit, income-related products, or maybe non-income like gold, which are refuge type of investments. So 20%. So Mike, you mentioned this idea of you were teaching portfolio theory as well, and you have probably a lot of thoughts on this.
Yeah, so I don't have a view on whether 50, 30, 20 is the right one or not. Again, no investment advice, but just from the academic research, there's only two free lunches in investing, and one is the power of compounding, and the second is the power of diversification. You want to diversify across asset classes, so public equities, public fixed income, and then you can start adding other private assets in there. And again, it depends on the investor's horizon, how much, right? I don't know what the right number is. But for many people, it's not zero to be invested in private in private companies and in private assets and those sorts of things. An interesting thing that we're seeing in the public capital markets, is you can be diversified across a number of different industries, which would give you the diversification benefit. But there's academic research that shows that you're starting to see more of co-movements in returns. What that means is that you're getting less of a diversification benefit across some industries. And why is that happening? Well, interestingly, one of Larry Fink's company is one of the reasons for that, where you have these mechanical investment flows in public companies that are part of indexes, where the BlackRocks and Vanguards and Fidelities of the world, if it's in a particular index, have to buy all the, with the inflows and outflows, their trading tends to move in the same direction. They co-move, even though you get diversification bits. So what you're getting is some returns that are not a function of the underlying company, but returns from the fact that they're in a passively managed index fund or an ETF. And so if public companies themselves are becoming more correlated, well, then the diversification benefits of moving to private companies becomes even more important.
That's fantastic. And so as you've heard it, the view is diversification is a free lunch, compounding is a free lunch. The only one you really have control over is diversification, because compounding is what it is. It's a great thing. It's a fabulous thing, but it's not something really you control. You don't control interest rates. You don't control growth, but you do control diversification for sure, 100%. And so that's one of the things we would like to have our audience consider when you're investing with StartEngine Private is you look at your diversification. Don't do a one and off, one done. Okay, I'll take this one. The name is great. Oh, great. And then, hey, I'll talk to you guys in 3 years or 4 years when we want to liquidate the fund and get my income. And then I'll say, well, you bet on one. It's going to be hard. At this point, I think we're going to ask for questions, and Josh, maybe you can help moderate this.
Absolutely. Yes. Thank you, Howard. Thank you, Mike, for going into all the details there. We've been accumulating questions over here during the presentation, and so I'm just going to start to go through them. Mike, maybe this one, it would be good for you. As we see more growth happen in the private markets, are the public market investors structurally disadvantaged by potentially not being able to access these private markets?
So yes, I've argued for a long time that folks that are not accredited investors are being left behind. And it's, the evidence shows that younger high growth companies have higher expected returns than more mature companies. And it used to be the case that high growth companies would go public earlier. You think of Apple and Amazon and some of these other companies that have done, incredibly well, but now they're staying private longer. So the growth, which is where you get the higher returns for investors, is accruing to accredited investors only. And so that has been on the radar screen, not only me, but other policymakers in Washington, D.C., who really want to open up these new investment opportunities.
And in that same vein, Howard, I mean, do you feel that the current accreditation rules still make sense given how the markets have evolved over time?
Well, those rules have been around for a very long time, and they were designed to protect investors. And when it was easier to go public, those rules made a lot more sense. So for example, Intel, when they went public, they raised $10 million to go public. It sounds completely ridiculous. It was in the 70s, but that was at the time where it was easy to go public. Apple went public when they were under $1 billion in revenue, way under, and these public offerings were less expensive, and the cost for maintaining a public company was less expensive, and the regulation was less intensive. You didn't have things like Sarbanes-Oxley, and these are buzzwords, but they are, if you want to look at them, they're designed to protect investors, but at the same time, the costs go way up. I mean, and so as the regulators were piling up all these new rules and the costs were going up, companies were like, well, hold on a second, it doesn't make sense. And the VCs were raising even more capital than they've ever raised, and they were able to get Series A, B, C, D, and more. And then the hedge funds came in, and then the pension funds came in, and everybody was getting into the game. And the investor, accredited investor, got into the game, but the one who wasn't was not participating. And so we've heard from the SEC that this idea of an exam is going to be offered eventually. We don't know when. We've also heard that there will be some other exemptions depending on the person's profession. And they already did that if you're a financial professional, obviously. But they're going to look at different factors. I think once they open up to a lot larger part of the population, this is going to take off even more, because we're not seeing any reversal of the trend. Mike was talking about how to make IPOs a little bit less expensive, easier to do. We have seen no evidence. In fact, the opposite. What you're seeing is that the large banks who do take companies public, the requirements they have to go public keep going up. The requirements are higher in terms of growth, profitability, or market opportunity. So this is why having access to private companies at this stage makes a lot of sense. You have a market of great companies not going public because of cost, regulation, and because the capital is available now to stay private longer. And then the question is, okay, well then why should I go public? So that's why you're seeing those companies staying private. And then we having access to these secondaries, which allow employees at those companies to cash out through the company, and then we have access to the shares. And that, I think, is the big opportunity.
Yeah. Josh, can I add to that?
Please.
Yeah. So Howard mentioned the wonderful intention of investor protection, right? And that's, one of the parts of the SEC's threefold mission, which is protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation, right? And so oftentimes the balance that the SEC has to strike is on how do you allow for capital formation, but in a way that investors are protected so you don't have the Wild West. With the accredited investor definition, the balance has gone too far. So, my background is I'm a PhD economist. And the reason why I mention that, in the history of the SEC, the 92-year history of the SEC, there's only been 3 PhD economists to be commissioners. It is an agency of lawyers. And why do I mention that? Not to bash lawyers, but in the intent to protect investors. What do they want to invest? They want to protect them from quote unquote, securities that are too risky for them. But lawyers think of risk in isolation. That's why you have in the prospectus and in the annual reports and the 10Ks, you have the risk factors that are listed for that particular security. And they think about the risk factors of individual securities. But as I've mentioned many times during the conversation here, is that from an economic and a financial perspective, it's the overall portfolio risk that matters. It's not the individual risk of securities. And once you get securities regulators that have that mindset that certain things are just too risky for individuals, then you're protecting them from what? Potentially good investment opportunities. Just to give one anecdote here. We talked about Apple being an example of a company that went public. In addition to federal securities regulation, we have state securities regulators throughout the United States, and some states are more interventionist than others. When Apple went public, the Massachusetts state securities regulator looked at this company and said, "Oh, they're too risky. They're too young. They don't have enough years of earnings here." So they prohibited Massachusetts investors from investing in the IPO of Apple to quote unquote protect them. Right. And so we have to be careful about when regulators say they're protecting you from stuff. What are they protecting you from? Potentially good investment opportunities.
I'm sure the residents of Massachusetts weren't too happy about that decision at the time. Mike, you touched on this a little bit, and Howard was just talking about it a little bit as well in his last answer. But do you think the rise of the private secondary markets is the new normal, or do you think we could see a rebound in the IPO activity, or maybe even both?
Yeah, possibly both. You got a lot of companies in the private market. So there will be companies that there still will be companies going public in the future, right? The question is when and which type of companies, in what part of their growth stage that they need, right? There's some in some cases, the public capital markets can get access to capital. Maybe it is cheaper in some particular cases, but the growth in the secondary market is going to continue for the reason I said. So they're on the demand side, the founders and the early investors need liquidity events and stuff, and the secondary markets and privates are providing that. And then on the supply side, you're getting more supply of these intermediaries that are coming in there, exchanges, brokers, folks that are managing the cap table and all that sort of stuff. There's a lot of money being invested in those companies, and those companies are investing a lot and they see the trends continuing. So that chart that Howard had, the cumulative annual growth rate was like 13%. I see that continuing at least on that trend, and maybe even a higher return.
Howard, you talked about the 50-30-20 portfolio split. People are asking, what steps can they take now to start building this type of portfolio?
Well, clearly, if you have a financial advisor, that's a good conversation to have. And because we don't provide financial advice on this webinar, I think the best way to explain it is this: if you have a good portfolio of public equities and some fixed income, and you have a right balance, and then you want to rebalance it, I think that's a good opportunity, is to say, okay, look, I'm going to take 20% of my investable assets, and maybe half, 10% of it, I'm going to look at private companies. And not just a private company, a few, many, maybe 7 a year, 6 a year, maybe 10, but not 1 or 2. That's just too small as a pick. And so we've offered 2 kinds of funds. One would be the single stock fund, and that one is great because you get to know exactly the company you're picking, but you should really pick 5 to 7. And then when you look at the ones where we have multiple companies in a fund, they are different themes. So you can pick 2 or 3 funds, 2 or 3 different themes as well to balance it. So it could be the chips, could be the AI software, could be automation, could be robotics. All of this is available. And the great thing about what's going on today with the private markets, the private companies, and the private secondary offerings is that the access is not just a handful of companies, hundreds of companies. And as Mike was saying, companies will still go public, and we've heard the rumors of different companies in different portfolios going public, which doesn't mean they will, but the rumors, or maybe they've already filed confidentially, or maybe they filed and they're on their way. And we've seen that. And I think this year it's hard to predict because anything can happen at any time. But this year it seems promising that there will be a number of public companies going public. And that will be great for investors who were in those companies prior to them going public. And there's no guarantee that it's going to give you big returns or no returns. Who knows? But the point is the diversification. You are now giving your portfolio a superpower, which is diversification. How do I continue to find things that will benefit my portfolio on a longer term basis, not on a month to months? And that is really the message, I think, of this webinar today. Is if you Mike said it so well, there's something free here. You get to diversify, and you control that. Compounding is one of the great values of investing. You don't control that. You just get to watch it and benefit from it. But seriously, consider building your portfolio with all the different private companies, and sticking to the numbers of not exceeding a certain percentage, because then you're no longer as well diversified. And the most important is pick Don't do the one or two and I'm done. And let me see how it goes, because it's not going to go as well as you think. And if you get lucky, I'll be the first to congratulate you. But if you don't, I'll be the first to say, look, having one was not the right strategy. So that's how I see it.
Mm-hmm. Mike, the one question here is, what steps are regulators and policymakers taking now to further democratize private investing? We talked a little bit about accreditation rules and things like that, but is there anything else that you're seeing or hearing?
Yeah, so Congress has had hearings on this over the last few years, and I've testified on this. So one of them is the accredited investor definition, right? So the SEC can do that on their own, but sometimes Congress likes to tell the SEC, "You shall do something," which means they have to do it, and do that. And another reason to get it done. Another reason to do that is that once it's in statute, you can't have, if a new administration comes in, you can't have them go back and, shrink the accredited investor definition again. So you want to make sure you have certainty, sort of, and finality on that. The other thing the SEC is doing is they're looking at, well, they've already done this on allowing more funds. So funds that are, think mutual funds, closed-end funds, to invest in private companies. So the SEC had a long-standing policy. It wasn't written in statute, it wasn't written in any regulation, that that funds were only allowed to invest up to only 15% into private companies. And now they've essentially lifted that cap. They have a lot of other different rules to make sure you have proper diversification and all kinds of other things, but that hard cap is gone. And so what that means is you have funds now that have a fiduciary duty and investor protection built right in that can invest more in these private companies. What's that going to do? Push the demand for these companies up, which is going to push the prices for this up. So you're going to have more types of investors in here. So even non-accredited investors are going to have access to the markets, through those sorts of things. You're seeing a lot of interest from pension funds. So pension funds that are regulated by the Department of Labor have been lobbying Congress to amend the statute that governs them. So for odd reasons, the Department of Labor oversees corporate pension funds and state funds and stuff, and not the SEC, to allow them to invest more in private companies without worrying about the pension fund going out and being sued because you're getting into, worry about plaintiffs' lawyers and that sort of stuff. So there's a number of different ways in which policymakers are looking at expanding opportunities for investors in the private markets.
Great. And obviously we're all very lucky to have your insight here today. But another question in a similar vein, Mike, is where can the audience stay informed about these policy changes? Is there, a website or something that, you recommend the audience view and stay up on to keep hearing the latest as to what's going on?
Yeah, I mean, there isn't one in particular. I mean, I would, so in Congress, it would be the House Financial Services Committee in the House and in the Senate Banking Committee in the Senate. Both of those in parallel have been sort of having two big focuses recently. One is on capital formation, investment opportunities. The other is crypto, and the crypto bill has kind of taken a lot of the oxygen out of the room. That seems to be stalling. So I think it looks like the Senate Banking Committee is going to be turning to some hearings on capital formation and taking in up what some of the things that the House has been doing. So including things like expanding the investment opportunities. The other would be the SEC's website, sec.gov. And on there, there's a number of different ways to keep track. So the commissioners regularly give speeches, and particularly the chairman. So there's multiple commissioners there. The chairman is the one who actually sets the agenda. His name is Paul Atkins right now. You can look at his speeches in terms of what his agenda is. And then for folks that are really into nerdy stuff and really want to go and figure out what's going on, there's something called the Reg Flex agenda. This is a DC term, but what this is you can Google this. You can SEC's Reg Flex agenda, and you can find it. It's actually on, I think, the OMB's website, where the chairman says, these are my stated priorities of rulemakings. That doesn't mean they're all going to get them, they're going to get them all done, but these are the stated priorities of things that they want to look at and see. And then, you know, there's a number of different news outlets that kind of follow those types of things. So Politico, Morning Money. I'm not endorsing anybody. These are just ones at the top of the head, right? So Politico, Morning Money is one. And then there's some, you know, some research analysts that follow this stuff. So I know, like, you know, TD Securities has a group that used to be called the Washington Research Group, that a guy named Jarrett Seberg there keeps track of a lot of the coming, you know, what's going on in the policy in the SEC arena.
Great. Awesome. Well, this has been tremendous. Thank you, both Howard and Mike, for providing all of this insight and information to all of us here today. Thanks to all the audience as well for tuning in and providing these questions as we've gone along that we were able to direct to both Howard and Mike. I wanted to just quickly wrap up and let everybody know that we have been recording this session. We will be sending this out to all of the people that registered for the conversation today. So that will come to your email that you use to sign up and attend and listen to this conversation. If anyone has any questions about things that we didn't get to, you can always respond to that email when we send out the recording here. Or you could also go to startengine.com/private and book a call with somebody on our team today to ask any more questions about you know, things related to these topics. So again, thank you, Howard. Thank you, Mike. Thank you, everybody. I know there's some storms and some cold fronts coming to certain areas of the country. I hope everybody stays safe and warm. And again, Howard, Mike, especially Mike, thank you for joining us today. It was really great.
My pleasure.
Yeah, thank you. Thank you, Josh.
Have a good day, everybody.